New tariffs on Chinese goods are pushing product prices higher and forcing many U.S. importers to halt shipments. The Port of Los Angeles is now forecasting a one-third drop in cargo for next week compared to last year.
What if your next smartphone, car, or hospital visit was influenced by a single decision made halfway around the world? On April 19, 2025, something significant occurred. China abruptly delayed $10 billion in U.S. cargo at the world's busiest port, citing routine inspections. Behind that explanation, however, was a much larger game being played. This was not a paperwork hiccup. It was a calculated move in an economic chess match that is currently rewriting the rules of global trade, from electronic shortages and rising prices to new tariffs and retaliatory port fees. What began as a shipping delay has escalated into a full-fledged showdown between the United States and China. And it is no longer just about trade. It's about power, resilience, and who has control over the future. In this video, we explain the real story behind the headlines. How did a port delay have global consequences? Who is actually winning the trade war? And how does it affect your wallet, your job, and the global economy? China delayed $10 billion in American cargo at the Shanghai port, causing major disruptions in the global shipping industry. Officials explained the delays as part of routine environmental and safety inspections. However, many analysts and logistics experts quickly expressed doubts about the true reasons for the abrupt shift. Given the already simmering trade tensions between the United States and China, this action appeared to be more about strategic retaliation than paperwork. Shanghai is no ordinary port. As the world's busiest port, it handles approximately 47 million containers per year, accounting for about 17% of China's total trade volume. Any disruption there has far-reaching consequences not only for China and the United States, but also for global supply chains. The decision to halt shipments had an immediate impact across industries, with goods ranging from semiconductors to electric vehicle parts and critical medical supplies stuck in warehouses and shipping yards. Logistics professionals familiar with previous trade tensions observed that the situation was extremely unusual. Historically, formal countermeasures such as tariffs were commonly used in trade disputes. However, in this case, China's approach was more subtle. Using regulatory inspections as a pretext, Beijing effectively stalled American cargo while avoiding direct penalties from international organizations such as the World Trade Organization. It was a calculated move to cause maximum disruption while maintaining plausible deniability. The backlog increased rapidly. Within 1 week of the delays, supply chain analysts reported a 20% increase in port congestion. Containers scheduled to move within days remained stuck, with no clear release date. Unlike previous trade disputes, which frequently targeted agricultural exports such as soybeans, this time the blow was aimed directly at the technology and healthcare sectors, which are deemed critical to national interests and economic stability. While the official line remained focused on inspections, the consequences were too serious to ignore. Businesses that rely on just-in-time supply chains started feeling the pressure almost immediately. Electronic device manufacturers, automakers, and hospital supply managers were all scrambling for alternatives or issuing warnings about impending shortages. The impact was especially significant in the technology sector. Semiconductors, which are the foundation of almost every modern electronic device, were among the delays. With the global semiconductor supply already stressed in previous years, this new bottleneck threatened to exacerbate an already precarious situation. According to reports, production schedules for upcoming consumer electronics such as smartphones and laptops are being revised to account for component shortages. According to insiders, the highly anticipated iPhone 17 launch could be delayed by up to 2 months. The automobile industry faced its own challenges. Companies like Tesla, Ford, and General Motors, which rely heavily on Chinese-sourced electric vehicle components, have begun warning investors and customers about potential disruptions. Battery production, a critical component of electric vehicle manufacturing, is dependent on specific materials and parts that move through Chinese supply chains. With an estimated 70% of some critical components originating in China, port delays created a bottleneck that no local supplier could quickly address. Small and medium-sized businesses were not immune either. Operators of electric van fleets, which are frequently used for urban deliveries, were informed that new vehicle deliveries could be delayed well into 2026. For many logistics companies attempting to expand or modernize their fleets with electric models, this setback posed significant challenges to growth plans and environmental commitments. The healthcare industry also raised alarms. China is estimated to supply 40% of the syringes used in the United States, as well as 30% of diagnostic kits. With these supplies trapped in shipping containers, hospitals across the country began reporting shortages. Some regions have warned that shortages may become critical as the annual flu season approaches. Unlike consumer electronics or automobiles, medical supplies cannot be easily replaced or stockpiled without careful planning, making the impact even more severe. As the delays continued, prices began to rise. The National Retail Federation predicted price increases of 5 to 10% on consumer electronics, auto parts, and household appliances by mid-2025. Analysts attributed this to a combination of product scarcity and rising shipping and storage costs. Every stranded container at the port of Shanghai was charged a daily demurrage fee, which could range from $100 to $200 per container. These costs inevitably filtered down to businesses and eventually consumers. For the average shopper, this meant significant changes. A smartphone that once cost $500 may soon be priced at $550 or higher. A small commuter car priced at $20,000 could easily cost $22,000 or more. In a market already facing inflationary pressures, these additional costs threaten to strain household budgets even more. Beyond consumer goods, the economic consequences were expected to spread across multiple sectors. Retailers such as Walmart and Target, which rely heavily on imported goods, had already adjusted inventory forecasts. Smaller businesses, which are less able to absorb unexpected cost increases or wait out supply disruptions, were forced to make even more difficult decisions about pricing, sourcing, and inventory management. The delays also had psychological consequences. For investors, it was a stark reminder of how fragile modern supply chains have become. Manufacturing, retail, and logistics-related sectors of the stock market experienced increased volatility. Companies with strong domestic supply chains or diversified sourcing strategies became more appealing, whereas those heavily reliant on Chinese imports faced scrutiny. Behind the scenes, policymakers and trade experts intensified their discussions. While the immediate cause of the disruption was in Shanghai, the broader context was the intensifying strategic competition between the United States and China. Both countries had already taken steps to strengthen domestic industries and reduce their reliance on each other. But the events of April 2025 demonstrated how interconnected and vulnerable they remained. Supply chain resilience has been a hotly debated topic for years, particularly following the disruptions caused by the COVID-19 pandemic. However, the Shanghai delays increased the issue's urgency. Industries that had previously taken global logistics networks for granted were now facing difficult decisions about diversification, stockpiling, and reshoring production. The situation also presented a challenge to international trade norms. While countries have always used regulatory mechanisms to protect local industries or enforce standards, the magnitude and timing of the Shanghai delays indicated a shift towards more weaponized trade tactics. If such measures become the new normal, global commerce's predictability may erode, resulting in increased uncertainty and higher costs overall. While China used regulatory slowdowns to apply economic pressure, the United States took a more direct approach, imposing new port fees on Chinese-built vessels. The announcement, made in late April and scheduled to take effect on October 14, 2025, marked a significant escalation in the ongoing trade conflict between the world's two largest economies. The newly introduced port fees are intended to penalize the use of Chinese-built ships in American ports. These fees range between $1 million and $3.5 million per ship, depending on the vessel's size, cargo capacity, and frequency of port usage. While not a traditional tariff, the financial burden imposed on shipping lines that operate Chinese-built ships is significant. The goal is clear: reduce reliance on Chinese maritime infrastructure and encourage carriers to source ships from other countries, such as South Korea or Japan. Almost immediately, port authorities across the United States began to plan for the aftermath. Gene Soroka, a senior official at the Port of Los Angeles, which directly and indirectly supports over 1 million jobs, has warned that a sharp drop in cargo volume could result in widespread layoffs. The Los Angeles and Long Beach ports handle nearly 40% of all seaborne imports into the United States, with a significant portion of that traffic traditionally reliant on Chinese-built vessels. A 10% drop in container throughput could have ramifications for local economies, port workers, truck drivers, warehouse employees, and regional businesses. Shipping data released shortly after the announcement revealed a clear response from the maritime sector. Container traffic from China to the United States had already decreased by 25% in the weeks following the initial port delay in Shanghai. With the added pressure of new port fees, major shipping companies began scrambling to restructure their supply chains. Carriers attempted to replace Chinese-built ships with those built by other nations, but the process was far from simple. China's COSCO Shipping, one of the world's largest maritime companies, owns a fleet critical to trans-Pacific shipping. Replacing their vessels on short notice is neither easy nor cheap. In response, many importers began stockpiling goods ahead of the October deadline. Bonded warehouses, which store imported goods before customs duties are paid, experience an increase in activity. Retailers such as Walmart, Home Depot, and Target are said to be increasing orders months in advance to hedge against upcoming port fees and potential supply disruptions. However, this type of stockpiling is not a viable long-term solution. Warehouse space is limited, and keeping excess inventory ties up capital that could otherwise be used elsewhere in the business. Meanwhile, the trucking industry began to experience early signs of instability. Trucking companies that rely on predictable container flows from West Coast ports have begun to report volatile freight volumes. One week saw overloaded delivery schedules, while the next saw unexpected drops. This inconsistency made it difficult for operators to plan driver shifts, manage fuel costs, and remain profitable. Small and medium-sized trucking companies, which already have thin profit margins, were particularly vulnerable. The larger retail ecosystem was not immune either. As goods became more expensive to ship and difficult to predict arrival times, retailers faced the dual challenge of rising logistics costs and declining customer satisfaction. Items that customers expected to see on store shelves were missing more frequently. For online retailers, shipping delays resulted in longer delivery times and more customer service complaints. Even global e-commerce platforms like Amazon and Alibaba began to adjust their inventory strategies in response to the increasing uncertainty. It is important to note that this was not just a logistics story. It was a story about economic philosophy and policy direction. The United States has invested heavily in efforts to bring critical manufacturing back on shore. Bills such as the CHIPS Act and the Inflation Reduction Act were introduced to boost domestic capabilities in industries like semiconductors, electric vehicles, and renewable energy. These are sectors where reliance on foreign suppliers, particularly from China, has long been regarded as a national security risk. However, while the intent is clear, the execution timeline remains a significant challenge. Many of the facilities funded by these legislative efforts are still under construction. Experts predict that the majority of these new manufacturing plants will not be fully operational until 2027 or later. Meanwhile, the United States continues to rely heavily on Chinese-made goods, which include not only finished products, but also critical components and raw materials. For example, China continues to dominate the global supply of rare earth minerals, which are essential components in the production of smartphones, electric motors, and wind turbines. China currently produces approximately 80% of these minerals. As tensions increased at sea and on land, the crisis spread to the skies. Air freight, which was previously a backup option for urgent cargo, began to experience significant disruption. Bookings for air cargo from China to the United States fell by 30% due to rising costs and political uncertainty. As a result, cargo volumes at major U.S. air hubs such as Chicago, Dallas, and Atlanta decreased significantly. With fewer goods passing through these airports, downstream businesses ranging from freight forwarders to ground handling crews were impacted. Meanwhile, businesses hoping to reroute supply chains through other Asian countries faced their own set of challenges. Shipping rates in Vietnam and Cambodia, two popular low-cost manufacturing destinations, increased by 15% in just a few weeks. Port congestion in these countries worsened as they struggled to meet new demand from businesses looking to avoid China. While these countries provide some relief, their infrastructure, capacity, and labor force are not yet fully prepared to handle such a large-scale shift in global trade. In Washington, policy discussions heated up. Additional tariffs were being considered as leverage in ongoing talks with Beijing. At the same time, trade experts warned about the long-term consequences of complete economic decoupling. They noted that cutting off all ties with China could reduce the United States. GDP could fall by up to 2%, costing hundreds of billions of dollars. This type of economic contraction would affect more than just corporate profits and government budgets. It would affect everyday consumers through higher prices, job losses, and decreased availability of key products. Despite these concerns, both political parties in the United States have expressed support for a more assertive trade policy. Lawmakers on both sides of the aisle have advocated for legislation to rebuild American manufacturing and reduce reliance on Chinese imports. Years of trade disputes, pandemic-related shortages, and now port delays have shaped public sentiment, and such moves appear to be increasingly popular, even if they come with short-term costs. At the same time, China is not remaining stationary. While American businesses and policymakers debate their next steps, China has been actively strengthening trade ties with the rest of the world. It has, in particular, strengthened its relationships with partners in Europe and Asia through a variety of regional and bilateral trade agreements. These efforts aim to mitigate the impact of reduced access to the U.S. market while increasing China's influence in other parts of the global economy. Back in the United States, the consequences of the escalating trade war are becoming more apparent with each passing week. Shelves are being restocked slowly. Businesses are paying more to secure the same goods they purchased last year. Investments are being redirected towards supply chain redundancy and reshoring initiatives. Consumers are noticing the difference not only in their wallets, but also in their everyday experiences such as shopping, driving, and accessing healthcare. Finally, the second phase of this ongoing trade conflict is revealing a harsh reality. The global economy, once founded on the principle of interdependence, is entering a period of fragmentation. Countries are increasingly valuing self-sufficiency and resilience over efficiency and globalization. For the United States, this means accepting that the transition will be difficult, expensive, take longer, and necessitate significant investment in domestic capabilities. The escalating standoff between the United States and China had evolved into something far more complex, a global power struggle fought out through trade, technology, and industrial policy. The events at the Shanghai port, as well as the U.S.'s retaliatory fees, were symptoms of a larger shift in which supply chains had become geopolitical instruments. Over the last decade, trade has progressed from spreadsheets and shipping manifests to the forefront of national security debates. Leaders in Washington and Beijing are now openly discussing economic policy in strategic and even military terms. In the United States, this thinking has influenced new legislation aimed at improving domestic manufacturing capabilities in critical sectors such as semiconductors, renewable energy, and advanced technology. While presented as economic revitalization, these initiatives are frequently justified as necessary for national defense and strategic autonomy. One example of this shift is the Ships for America Act, which was introduced in early 2025. The bill calls for a complete overhaul of the U.S. shipbuilding industry, which has been in decline for decades. China currently builds over 1,700 commercial ships per year. In contrast, the United States constructs fewer than 5. Some policymakers see this disparity as not only an economic disadvantage, but also a strategic liability in the event of a larger conflict, particularly in the Pacific, where control of sea lanes remains critical. The push to rebuild U.S. maritime infrastructure is about more than just cargo. It also reflects concerns about military-commercial overlap in China's shipbuilding industry. Many Chinese commercial shipbuilders are state-owned or work closely with the government, which raises concerns about dual-use technologies and strategic planning. From that vantage point, every container ship, tanker, or bulk carrier becomes a piece of a larger chessboard in which economic resilience and military readiness are increasingly intertwined. These strategic concerns are also reflected in discussions about rare earth elements. The United States continues to rely heavily on China for these minerals, which are used in the production of everything from guided missiles and radar systems to electric vehicles and smartphones. Though efforts are underway to develop alternative sources in countries such as Australia, Canada, and the United States, Establishing a fully independent supply chain for rare earths is a long-term project that will not be completed overnight. In the short term, any disruption in access to these materials could have repercussions not only in consumer markets, but also in the defense industry. The growing emphasis on national security has added to the complexity for American businesses. Firms that previously viewed China solely as a manufacturing base must now consider the strategic risks of continuing operations in the country. Some are deciding to shift manufacturing to countries like Vietnam, India, and Mexico. Others are investing in automation to boost domestic production. However, none of these moves provides a simple solution. Each has trade-offs, and complete disengagement from China remains difficult, especially in high-tech industries. At the same time, China is not remaining stationary. In response to growing restrictions from the West, China is stepping up efforts to increase its technological independence. The country aims to lead in AI, robotics, and quantum computing through programs such as Made in China 2025 and more recent digital economy initiatives. It is also increasing investment in regional partnerships, particularly through trade agreements like the Regional Comprehensive Economic Partnership, or RCEP, which connects China to major economies in Asia-Pacific. China is attempting to reduce its reliance on Western markets by strengthening ties with Southeast Asian, Middle Eastern, and African countries, while expanding its influence in emerging regions. These initiatives are part of a larger strategy that combines trade, infrastructure investment, and diplomacy. The Belt and Road Initiative, which started as a massive infrastructure push, has evolved into a tool for strengthening bilateral ties and ensuring long-term economic alignment. This global realignment has far-reaching implications for supply chains. It has an impact on how data flows across borders, investment regulations, and even the development and control of digital currencies. For example, the increasing use of the Chinese digital yuan in cross-border transactions reflects a larger desire to challenge the US dollar's dominance in global finance. As more countries adopt or explore non-dollar trade systems, the financial foundations of global trade may gradually shift in a way that reduces America's traditional leverage. One of the most immediate risks associated with this strategic contest is the possibility of miscalculation. As trade becomes more weaponized and policies become more aggressive, the margin for error decreases. An escalation in tariffs or port access could quickly lead to broader diplomatic or even military tensions, especially in contested areas such as the South China Sea or Taiwan. This makes the current economic standoff more dangerous than previous trade disputes, which were largely focused on tariffs and quotas. The issue of Taiwan is particularly sensitive. Taiwan, as the world's semiconductor manufacturing hub, is an important link in the technology supply chain. Any disruption there, whether caused by economic pressure, military conflict, or political crisis, has the potential to send shockwaves through global industries. The current trade tensions demonstrate how vulnerable these supply chains have become and how intertwined they are with regional security dynamics. While some experts believe that decoupling is unavoidable, others advise against viewing it as a binary choice. Full separation from China could have serious economic consequences for both sides and the world as a whole. Several economic studies suggest that a complete decoupling between the United States and China could reduce global GDP by trillions of dollars over the next decade. In an already uncertain economic environment, such a shift could result in prolonged slowdowns, higher unemployment, and increased geopolitical instability. Instead of complete decoupling, trade networks could be reconfigured. Friendly shoring, regionalization, and strategic redundancy are terms that have become commonplace in corporate boardrooms and government planning meetings. These ideas center on creating supply chains that are not necessarily shorter, but more politically stable and diverse. Companies, for example, may continue to operate in China for local production, while moving exports and strategic manufacturing to other regions. Meanwhile, consumers are becoming more aware of the overall impact. Price increases, which appeared to be temporary, are becoming more persistent. These supply chain shifts affect everything from smartphones and electric cars to prescription medicines. And with inflation already a major concern in many economies, further disruptions could exacerbate the situation. In response, governments are implementing new policy tools to deal with the fallout. Export controls, tariffs, subsidies, and tax breaks are all used to sway corporate decisions. While these measures aim to make economies more resilient, they may introduce distortions and inefficiencies. Protectionist policies may help to build domestic industries, but they can also raise prices and reduce innovation if not managed properly. At the societal level, these changes are altering people's perceptions of trade and globalization. For decades, global trade was viewed as a major driver of economic growth, innovation, and lower consumer prices. However, it is now increasingly being viewed through the lenses of control, resilience, and risk. Supply chains are more than just business tools. They are strategic assets. The transition of supply chains from neutral pathways to geopolitical instruments represents a fundamental shift in the nature of global commerce. And while it is too early to predict where this shift will eventually lead, one thing is certain: the landscape has changed. Businesses, governments, and individuals must now navigate a world in which economic decisions are inextricably linked to political ones, and where the movement of goods is as much about strategy as efficiency. The decisions made in the coming months and years will determine whether the current standoff becomes a long-term economic Cold War or a new balance of power. What is clear is that the current disruptions, while temporary in nature, are part of a larger realignment. The trade war, which began with tariffs and inspections, has led to a broader, more profound struggle for global influence. Finally, this is about more than just ships, ports, and fees. It's about the future of the global economy and the competing visions that will influence it. The events of 2025 may be remembered not only as a trade dispute, but also as the dawning of a new era marked by resilience, rivalry, and the redefinition of economic power.